Hey everyone, and welcome to my channel. This is Sophie, and I'm Sophie's daddy, hiding behind the computer, and you might know my motto: if it's complicated, let's break it down. Last time, our AI Charlie Munger bot said Apple, AAPL, looked a bit pricey. So how do we figure out what a stock's worth? There are two main ways to value a stock, or valuation analysis. First, relative valuation. That's comparing a company's ratios like PE ratio to others, kind of like checking Apple prices at different stalls. Then there's absolute valuation. This is about finding a company's intrinsic value based on its fundamentals. It's like examine one apple deeply. And it is our focus today, DCF model, also available at SOPHIE-AI-finance.com. Ready for a quick trip? If it's complicated, let's break it down. So Sophie asked Video Tutor to create a quick 1-minute AI-generated explanation of DCF model. Let's take a look at that first to get the basic concept down. Feel free to skip ahead if you're already familiar with DCF.
Discounted cash flow, or DCF, is a fundamental valuation method used to determine the intrinsic value of a stock. The concept is simple. A company's value equals the present value of all its future cash flows. We project the cash flows the company will generate over time, then discount them back to today's value using an appropriate discount rate. The DCF process involves 5 key steps. First, we project the company's future free cash flows, typically for 5 to 10 years. Second, we estimate the terminal value representing cash flows beyond our forecast period. Third, we determine the discount rate, usually the weighted average cost of capital, or WACC, which reflects the company's cost of financing. Fourth, we discount all future cash flows to present value. Finally, we sum these present values to arrive at the company's intrinsic value. Let's work through a practical DCF example. Consider a company with projected free cash flows of $100 million in year 1, $110 million in year 2, and $121 million in year 3. We estimate a terminal value of $1.5 billion and use a WACC of 10%. Using the discount factor of 1 divided by 1 plus WACC raised to the power of the year, we calculate present values. The total present value sums to approximately $1.4 billion, representing the company's intrinsic value.
Okay, the basic concept of DCF sounds easy, right? But a full-blown professional DCF, that can be a real monster. Why? Imagine detailed multi-year projections for every tiny financial item, not just a simple growth rate and the latest free cash flow. And the discount rate, or WACC, that involves a super intricate calculation with many parts like cost of equity, cost of debt, and market values. It's tricky even when simplified. Plus, 5 to 10 years of projection period. Professionals run tons of sensitivity analyses in different scenarios. It's a mountain of work. But hey, we're not Wall Street analysts. We can use a DCF in simplified way and it's still incredibly insightful. So what are the key ingredients for our simplified DCF? First, current free cash flow. You'd find this in its financials. Second, growth rate, how fast FCF might grow for the next 5 years or so. Maybe we estimate 5%. And for long-term stable growth, say 2 to 3%, similar to overall economy growth. Third, the discount rate, maybe 10% for a reasonably stable company. Those are our main knobs. So what does a simplified DCF tell us? It gives a general sense if the current stock price is way off from potential earnings. It helps us understand the key drivers of a company's value. It helps assess if the current market price makes sense under our reasonable assumptions. And it connects the stock price to fundamentals like FCF and growth. Plus, here's a cool trick: reverse engineering market expectations. Use a solver to see what growth rate is implied by the current stock price. This shows what you have to believe for the price to make sense. And hey, if this video gets 100 likes, I'll build that DCF solver tool for you on SOPHIE-AI-finance.com. Now, you know me, I had to take this a step further. I did my own Gemini deep research to demonstrate how AI can really help with this stuff. You can find the full research report I put together over at SOPHIE-AI-finance.com. In my research on Alphabet, that's Google's parent company, I had AI help calculate the DCF in a couple of ways, including a more comprehensive one. The simplified 5-year DCF model yielded an implied share price of $149. The comprehensive 10-year DCF model came up with an implied share price of around $132. But at the time of the analysis, the market price was way up at $173. That gap means that, based on the specific assumptions in that particular DCF, the stock appeared overvalued, offering very little margin of safety. The market was clearly factoring in much more optimism, perhaps expecting higher growth, a lower discount rate, or faster monetization of AI. DCF helps us spot these differences and ask those critical questions. So what are the takeaways today? First is the concept of DCF. At its heart, DCF is about valuing a company based on the future cash it's expected to generate, all brought back to today's terms. And why do we bring it back to today's terms? Because, as the saying goes, money in the future is worth less than money in your hand right now. That's the core idea of the time value of money. Then for us regular investors, using DCF isn't about getting an absolutely precise to-the-penny price target. It's really about helping us understand the underlying value drivers of a business and to gauge if the current market price is reasonable given a sensible set of our own assumptions. Last, advanced large language models such as Gemini Deep Research is a fantastic tool for this kind of analysis, no doubt. But it's so important that you still need to grasp the basics and understand what the numbers mean. That was a deep dive. What do you think? Let me know your thoughts in the comments. Visit SOPHIE-finance.com for all the details. It is completely free dashboard, no login, no subscription, need nothing from you. It is my personal hobby website. And as always, if you found this helpful and want to see more breakdowns, don't forget to like, subscribe, and hit that notification bell. Until next time, keep decoding and remember, if it's complicated, let's break it down.